or having nice holidays, or whatever you would say in the middle of the Christmas and New Year's period. Well, look at IBM. IBM's chugging along, huh? Holy cow. Should be the Dow, though. Oh no, S&P's recovering. I was doing so well. Here's my ES. Oh, well, still good. So, in the moment, up $1,400 on, so $500 per contract, basically. Had 3 contracts, average 47.85. You know, we decided to short the S&P, and as I said this morning, we got a nice shoot up above 47.80, so I wasn't inclined to start shorting. But then when we hit 47.85, I started shorting, and I took 2 around here, and I took 1 up here, but the average is only 47.85, 41 is the way it worked out. But that's fine, because that's higher than I expected. I was expecting that. Well, no, I think we were saying if it actually goes all the way up to 48, we'll average 4787, and that's probably going to be about right. So we're kind of on track for where we should be for this. So that works out. We'll see that. Oil has been a little bit crazy up and down. It's just too dangerous to play into the new year. There's too much manipulation and crap. You know, and this one too, but like I said, the point is we already have a tremendous long position in the long-term portfolio. So you have to keep things proportional. The long-term portfolio, here's the short-term portfolio. Now, the short-term portfolio isn't getting hit too bad. There's another big bonus. The short-term portfolio isn't taking much of a hit because our primary short is on the Russell, and the Russell is the worst performing index, if I could find that. So if you look at the Russell, since we officially shorted it down around here, the Russell is still staying way down. We're not getting damaged by the Russell. If we had the other indexes with our primary short, we'd be in trouble. But it's the Russell that we've been shorting, and that's staying okay. So we haven't gotten too much of a hit. What the hell was that? Not too much of a hit in the short-term portfolio. And, oh, this was not good. I was so disappointed. If you're going to advertise, I'm going to talk about it. I was like, come on, are you kidding? It was literally like I gave my daughter the 3 Matrix movies from before and said, here, cut these up into a new movie. It was like not enough. I forget it. It was just, I don't think people get that about these movies. And I think that's also a problem with the new Star Wars series. I think it's a problem with a lot of stuff. The reason Star Wars was Star Wars wasn't just the story of Star Wars. And this is very hard to do unless you live in the moment. But I mean, I will never forget. First of all, we didn't even know what Star Wars was. We were driving down to Florida, and we stopped somewhere in like South Carolina, North Carolina. I don't know, some motel somewhere. So it was a motel right on Route 1. And we had been driving it to down to Florida from New York. And we just stopped at a random hotel, and across from the random hotel was a random movie theater. And in the random movie theater, they were playing Star Wars. In those days, there was a movie theater. It had a movie, and you either saw it or you didn't. So we had nothing else to do. We're in the middle of nowhere, and we went across to see the movie with Star Wars. Didn't even know what it meant. I mean, I guess, you know, if you were into that stuff at the time, I mean, I was young, so I don't remember how young. I don't remember what year it was. It was like 1980, though, wasn't it? So, no, it wasn't even 1980. It was probably 70 something. Let's see. This is the important stuff, right? Star Wars release. I'm sorry, I'm like a fact addict. 77. Okay, so there you go. And I was born in 63, so I was like 14. So I'm 14 years old. We're driving down to Florida, and we're sitting in the movie theater. Now maybe if I was 19 or 20, if I watched the Tonight Show or something like that, I might have had some clue as to what this movie was, or I would have known something was coming out. I don't know. But nobody in my family knew what it was. So you're sitting there, and the movie starts and it scrolls those letters. But the first thing that happens in Star Wars after the letter scrolls, which by itself is a very cool effect, the scrolling letters. Then a ship goes by across the top of the screen, and meanwhile the speaker and the sounds were good. The theater, thank God, had all the accoutrements that went with the movie. So the speakers were good, the sound was good. It was a great, we were right in front of this huge screen, and so the ship goes by. And you're like, oh, whoa, a spaceship. And it was one of the coolest looking spaceships we had ever seen at the time. You look at it now, it looks like a rinky-dink thing that makes Star Trek look up to date. But it was a spaceship goes across the screen. You're like, oh, shit, that's way cool. But then that ship is being chased by a much, much, much bigger ship that goes across the screen. And, from that moment, you're hooked. I mean, you see that effect. It's not and the creatures, hokey as they were, when you look at it now, and you're like, oh, that's all shit. But as hokey as all that stuff was, at the time, that was the greatest stuff we'd ever seen. That was state-of-the-art stuff. And so it's not the movie or the story or this or that. There's a whole sort of thing that goes together with the times that you're living in and how you feel about something that makes a movie a hit. And so for The Matrix, there was a time when we felt a certain way about technology and computers, and our understanding of it was such that it was all like, wow, cool, amazing. The effects were amazing. No one had ever done that before. So when they remake The Matrix 20 years later, and the story is basically the same story, except now it's 20 years later and he forgot everything that happened 20 years ago. That's idiotic, okay? That just means you couldn't figure out a plot. Then the problem is also there's zero new effects. I mean, nothing really new in the effects department. So there was nothing stunning technologically. And, we all know what the metaverse is. We've all seen these virtual walkthroughs and things like that. So nothing about it seemed exciting. There was no real content to the thing. That was the problem with it. So it was just completely ordinary, boring movie that, had all been done before 3 times in the 3 Matrixes. So where were we? Oh, yes. We had an annoying ad somewhere. That was what ticked me off. That. And I think when something goes straight to cable now, even after all this COVID stuff, when something goes basically on cable the same day as it's in the theater, there's a problem. And they just wanted to get on TV before people hear that it's not good. Spider-Man, however, and I love Spider-Man, it's doing $1 billion. I haven't seen Spider-Man yet because I couldn't even get into the IMAX. The IMAX is full by my house. So I'm waiting until next week and I'll go see it in IMAX. But and Spider-Man did $1 billion worldwide. So it's like a proper, super duper hit. And everybody says that's great. So, hopefully they figure this out. I mean, this is just a complete waste of money, talent, everything. It's just, what a total waste of whatever they spent on the movie. So where were we? Yes, stocks. So, there's no volume. And I always look, when I'm looking for volume, I always find Yahoo. I always look at SPY because I think, the S&P ETF is a good proxy for the market, and you get an accurate reading for the volume, and that's what I really like about it. So I go to historical data on SPY, and I look to see how much is trading on a given day. And we came up with a theory a while back in the last dip that it takes about over 120 million trades. So on days when there's more than 120 million, like that, that's when you're going to have too much. That's when the selling pressure is coming in. So these kind of days are bad. So you would look at November 30th to December 3rd, and you'd say that must have been a bad period for the market. And then you verify that with the chart, and you look at the S&P. This keyboard's getting to the point where the things are wearing off, so it's like you have to kind of know where something is to use it, which is not my strong suit. So maybe time for a new keyboard, but I'm just very happy with this one. Let's see. So so here we are, 11:30. So you can see the downtrend, right? So when does it start? It starts on 11:26 and it turns around after the third. So now we go back to here and we say, okay, what happened on 11:26? See that big surge in volume? So big surge in volume, a pause on the 26th, which I guess was like, the day before Thanksgiving or whatever it was. What was that, Friday? Was November 25th Thanksgiving? Is that what happened? So this was like the day before Thanksgiving. Yeah, Thanksgiving Day was the 25th. So day before Thanksgiving was the 24th and the 25th. So then the 26th volume jumps up. 29th is a Monday after Thanksgiving, so we were slow. But then boom, 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 and the third, and then it starts turning up. But when it starts turning up, the volume comes back down. So the volume is not, there's a certain automated amount of buying that goes on in the market. There's a certain inflow from 401ks and IRAs and so on and so forth every day that's a buy. There's a buy inflow that's constant. The Fed is constantly with their QE stuff is buying or putting, the Fed gives money to the banks and the banks buy stocks or whatever with it. So the Fed takes notes off the bank's hands and the banks are able to buy equities with it, especially JP Morgan, Goldman Sachs and such. And so money is constantly pouring into the market. Plus you got corporate buybacks, which is on a record pace again with the corporate buybacks. So there's a lot of factors driving the market forward. So unless you have, so let's say you have 60 million purchases going on the average day. And if you figure the average S&P stock is $50, so that's 60 million times 50. It's only $3 billion. So, you're not talking about a lot of money. It's not like some mind-bending amount of money. That is billion, right? Yeah, 3 billion. So if in an average day, $3 billion is coming in, $3 billion of purchases are actually made where somebody takes money out of their bank and buys a share, right? Well, is that balanced out by $3 billion worth of sales that people make? The $3 billion worth of people decide to liquidate. Now, keeping in mind, liquidating means actually liquidating, not just selling one stock and buying another, because then you're netting back into the market. But we're talking inflows and outflows. So the amount of people who are buying, taking cash out of their pocket and converting it to a stock is matched by the amount of people who are taking stock and looking for cash at an equilibrium that is roughly around 120 million. But once you get over 120 million, there doesn't seem to be a lot of extra buyers to be found. So in other words, if you're going to get more volume, that volume tends to be selling volume. More people are liquidating and more people are looking for cash. And that's why the market drops once you get past that point. You're past the equilibrium and it becomes very, very hard to find new buyers for more sellers. Now, sadly and dangerously, even 120 million is a very small amount. 120 million is what used to be a holiday traffic. Now we're doing 50 million, 60 million. That's insane. So in other words, the only activity going on here is basically buying activity. There is no other activity. I mean, obviously some people are selling and whatever, but realistically, you're overwhelming the sellers with buyers because the buying is automatic and it's always going to happen. But the selling comes when it comes. And unless more buyers step in at the same time, boom, imbalance and the market starts going down. But the problem is you're capable in the market of having 200 million, 300 million sales in a day on the S&P very easily. We've had in the old days, we would have 500, 600 million. But even now, you could have 200 million, 300 million. And if we have an imbalance like this, they're going to shut the S&P down. It's going to hit its breaking point. So that's a danger of a thin market. And it's also very dangerous to rely on it. And it's extremely stupid to sit there and try to do charts and ignore the fact that there's no volume to the chart. If there's no volume to the chart, then it's meaningless. Then all these points are irrelevant. This is not data. You have not got a big enough sample size to determine anything from this data. This is just random data from a small sample. In other words, what is the temperature of the room? The temperature of the room is the average temperature of the molecules that are there in the room, right? If you go to any corner of the room, you could get a warm spot or a cold spot, right? And if you took the tiny sample from one little place in the room, or 3 or 4 or 5 places in the room, you're not going to actually know what the temperature of the room is. So it's the same thing with the market, okay? The market is just basically pricing a very, very small sampling. You have no idea what's really happening, and you can't draw any conclusions from it. So when you start seeing this, you know, and against the averages, when you see the averages here, then readings that you get here are real readings. Readings you get from oversampling are kind of real readings, but you also have to realize that this is that imbalance of sales I said. So if there's a panic and more people sell, there simply aren't any buyers. That doesn't count either then. That's not fair. You overwhelmed it. It's like a flood. It's like a flood going over the riverbank, right? The riverbank, you look at a riverbank and say, will that riverbank be high enough to hold the river in a high tide, whatever, or, you know, when it's flush, when the snows melt or whatever. You say, will it be high enough? And you say, well, yeah, it is usually. And you say, what do you mean usually? Well, sometimes there's a big rainstorm and extra water comes in, and the water spills over the riverbank and floods the low parts of the town. That doesn't mean the riverbank is no good. It doesn't mean that you have to raise the riverbank and spend hundreds of millions of dollars. It means that once in a while you're going to get a flood. You have to determine whether it's worth trying to stop the flood from happening, or everybody should move, or whatever, you know, whatever you have to do. So the market's like that too. That's why with the 5% rule, we do our best to ignore outlying moves. So we would not count that as a move. We'd say 4,600. See, if I'm looking at the 5% rule, I would say 4,600 held. And this is what? This is a weekly. No, it's daily, sorry. So we would say 4,600 held. Why did it hold? Well, because who cares about that? That's just one outlying day. What matters is 4,600 held here, it held here, and it held here. You know, so we look at the 4,600 line and say that's what held. You know, you got to throw out the noise, and you have to understand what you're doing. Is, you know, when you're looking at a chart, you're doing statistical samples. You're not getting a true vision of the market. And of course, closings are the worst, because you know, when you look at what something closes at, because again, that doesn't matter either. The spikes of the candles above and below are meaningless also. What matters is where is the average at? So that's why you want to look for these trends that average out. You can see here 4,700 is a significant line. And then 4,800 is going to be a significant line. So another reason I don't mind being short up here, right? Because this seems like a line that's going to be hard to get over. And it's also very likely we're going to correct back to the 50-day moving average at some point. And that 50-day moving average, because we know how charts are built. That's the other thing. These aren't magical lines. This can't suddenly go up like that. Why? Because it's a 50-day moving average. For this line to go from 4,650 to 4,700 is up 50 points, right? So in one day, it would have to go up 50 times 50 points, because it's a 50-day moving average. It would have to go up 50 times 50 points, 2,500 points higher for this line to go from here to here. Well, that's not going to happen. It's not going to. You're not going to have a day where we suddenly where during the day we get up to 7,000. So that can't happen. And then you have to say, well, what has to happen over 50 days? Well, over 50 days, you have to be 100 points higher for the average to move from 4,650 to 4,700. So you have to average 4,750. Now we're at 4,750 now. So if, in fact, it would be 25 days. If this line stays at 4,750 for 25 days, since we're starting at 4,675, the average will be drawn up by 50 points, because these days matter less. In other words, the last 25 days here would get cut off, and all that you'd be measuring against this. I mean, you could be more exact about the measurement, but you get the idea. So after 25, 30 days, whatever, it would take a month, or not a month, 30 days is a month and a half of trading. It would take 30 business days before this line can get to 4,700 in anything that's conceivably ordinary. Now, this could go up to 48.50 and 49, and maybe this will go up faster, but there's no way in less than 2 or 3 weeks this can possibly get to 4,700. So that's just not going to happen. And if this goes to 4,850 and this can't get to 4,700, then all you've done is increase the gap between the 50-day moving average and where the channel is. And then you go back historically and you say, well, that doesn't really happen very often. Here's a big gap. Here's a gap from 45 to 47. Here's a 200-point gap. And that seems very strange. So if you look back historically, we don't have 200-point gaps. 150-point gaps is about as much as you get. So a 200-point gap is significant. And that means that you don't expect it to last. So if you get to a 200-point gap at 4,850, you do not expect that to last. You're looking for a very, very likely correction. So even if we got to 4,850, which is what it would take to bring 47 to get up to 4,700 in less than a month, even if we do that, then the strain on it over the next 10 days would be so much that it's not very likely to sustain that level without being pulled back down. That's how you look at a chart. You have to think about how and why the chart is drawn. And that goes for a 5-minute chart. It goes for anything, though. You have to think about the math that's involved. The math draws the chart. The chart doesn't draw the math. So a chart doesn't make Apple go to 800. A chart doesn't make Tesla worth 1,600. It's bullshit when they tell you stuff like that. Those people are idiots. Sorry, TA people. I apologize. I just realized there are TA people out there, right? But in other words, so the value of Apple isn't driven by the chart of Apple. And now notice this. This is 160, so 175 is 10% over the line. And you say, how often are we 10% over the 50-day moving average? Not very often. Here, 135 to 150, that's 10%. So here's the behavior, and you go back further, of course, you go like this. But now you're looking at the 200-day moving average, so you're gonna get the tightness. But yeah, historically, look at the 200-day moving average. Here you're like, here the 200-day moving average is like 85, and this is 135. So 50 divided by 85 is 58% over the line. That is massive. That is just completely massive. Now, it did correct back to the line over time, but it didn't correct until the line came up to 118. So what this is telling you is that this line here and the trend here was way behind the reality of what these earnings were and what was being turned in and so on and so forth. Now, of course, it's back in 2020. There was stimulus, there was stuff like that. Everybody's locked at home. Everybody's buying Apple. They had a great year. But you'll notice it happens, but it's rare that you get a pop like that and the price of the stock will pull the trend up like that. Usually the trend is right. But this was based on, well, first of all, this line was low because of this, which was idiotic. We know that was idiotic in retrospect. We knew it then, we knew it at the time too. But this was idiotic. The real price should have been 80, and this should have kept going like this. This should have kept going like that. And that's why that's the right price, because when you follow this line and you get to here, this was actually the correct price. It might not have gotten there in a straight line. It might have taken time and whatever, but the bottom line is this was not a crazy price. This was just back on track from where it was back here. What a freaking company, huh? $3 trillion. Are they at 3 trillion now? They should be right about 3 trillion right now. Yeah, 293. So 180 is basically 3 trillion. That's crazy. Anyway, so when you're looking at a chart, here we go. When you're looking at a chart, you have to think about what is this line. This line is the 50-day average of this line, of these prices. So this is the 50-day average. It is currently very much above the average. It's currently very much above the average. You look back historically and say, how much above the average can we get? So here's 143, the 200 days at 143, and we're 40 points higher than that at 180. So again, it goes back to the same thing. Ignoring this time that it did that, if you take this and average it out lower, take the lower end of this thing, this is still, I mean, it's impressive. It's 20, but it's about 25% higher than, it's about 25% higher than the 200 before, but it comes back. See, it keeps coming back to the 200. Now, the 200 doesn't pull the stock price down. The 200 is the average, but the point is you don't constantly trade above the average like that and pull the average up. It's these people were not all idiots. All right, these people were idiots, but not all these people were idiots. They, after a month of trading, you figure they kind of knew what the price was. Then the world went crazy. There was a lot of uncertainty. People forget what the price is. Then people go back and start relaxing, saying, okay, here's the price of Apple. And it turns out they were kind of right. And now for a year, we've been trading around here. And now people are reassessing again and saying, you know what? They still got legs. Even at $3 trillion, they still got legs. And why is that? Because if you go back to Apple, and again, the chart cannot by itself tell you what's going on. But if we go to Apple now and we say, well, how do you get $3 trillion? That's such a freaking lot of money. Well, they're making $100 billion a year. Okay, it's like $3 trillion is 30 times earnings, but you know what? Their earnings are growing pretty freaking fast. They were only making $57 billion in 2020, $55 billion in 2019. No, they didn't even lose a step in 2020. 2021, $94 billion. Now they're in the 90s consistently. And you know what? This Apple car crap is going to be, excuse me, there's more left than I thought. So this Apple car crap is going to be huge. Apple home stuff eventually is going to be huge. So they've still got cars and homes to deal with. And as many people have cars basically as have phones. So that's a big market. And if they do it right, you've been in a BMW, you've been in a Porsche, you've been in all the fanciest cars, whatever. You've at least got friends who have them or something. Even Tesla, you've seen their systems. They're not, in fact, the number one system right now in cars is Apple CarPlay, which is all it's doing is like translating your iPhone to your car. That's the audio system people like the most in the cars. When they have an integrated system that's designed for the car that works with your phone so that you seamlessly, you get into your car and your car recognizes your phone's preferences and does, and that's your driving preferences. And by the way, this is a very big thing when we get to driverless cars, because you'll get picked up by random cars. Right, with driverless cars, you probably won't own your own driverless car. It's most likely going to be like a lot of Uber kind of stuff. But when a driverless car picks you up, if part of picking you up means it configures, and one of the services, I think it's Uber or Lyft, either Uber or Lyft, one of those two guys, they have a thing that says set your preferences for the car. So you set if you like a certain kind of music, if you like a temperature in the car, if you like, if you want the driver to talk or not talk, even that. So you can set the preferences. And when Apple has that down, and that's going to be for your phone and your car, of course you're going to want that, right? You're going to want to have a car where you get in the car and by the time it gets to you, it's exactly the way you like it. The seats are where you want them, the temperature is where you want it, the music is what you want to hear. Everything is set the way you like it in the car. You get kind of used to that, right? And that's going to happen in hotels, and that's going to happen in homes. When you go somewhere, you'll take your environment with you. You'll set your environmental preferences and they'll follow you around. But that takes an ecosystem, and Apple is the most likely person to be able to pull this off. Theoretically, Android can, but Android is not a single thing. The Android operating system is broken up into many, many different companies' own flavor of it, and they don't have a very good overall integration on top. So it's going to be a lot harder for Google to do this and for Apple to do this, because Apple is very controlling, and then people say that's a bad thing about them, but on the whole, it's going to let them do cool stuff. So So even though it's 30 times earnings, I don't like Apple at 30 times earnings. I'm not thrilled with it. That's why we don't have a lot of it right now, except in the butterfly portfolio. But there we're selling it when it gets expensive. But it's a little rich for my blood, and I'll wait for one of their classic pullbacks because they disappoint people and everybody freaks out. But, you know, you get down to 20 times earnings, which would be 120. So you're down in the 120s, and this is a total buy, no question about it. This company is just a juggernaut. It never stops. You know, but again, you have to look and say, does the value justify the company? Is this actually worth this kind of money? Here's our buddies at Tesla. I wonder if they're making any money yet. I mean, they're making money, but if they're making anything like the value. So Tesla's hovering around $1 trillion. And they're making, well, it's not bad. No, it's not bad. It's not as bad as I thought. They're making $6.5 trillion and $8 trillion. So God bless them. I mean, they're going to make 10 trillion. I'm sorry, 10 trillion, 10 billion. They're going to make $10 billion. But unfortunately, even if they make $10 billion, a trillion is 100 times that number. Still trading at 100 times earnings. And that's selling, let's say, 2 million cars. Now, so what are the questions? Will Tesla be able to sell 20 million cars to get down to, instead of 100 times earnings, 10 times earnings? Will they be able to sell 20 million cars instead of 2 million cars? And what are the chances of that? Well, does Ford sell that many cars? You know, that's as much as Ford or GM sell now, probably a bit less than Toyota sells. You know, so is Tesla going to be one of the big three automakers is the question, because that's what they're priced like now. And that's going to depend very much on the market and so on and so forth. But obviously, I wouldn't touch them. I'm not going to pay 100 times earnings for a freaking car company. And, you know, SpaceX is its own thing. It's not Tesla. When you buy Tesla, you're not buying SpaceX. So people, you know, Elon Musk tends to make it very blurry about what everything's worth and how it works and so on and so forth. He just launched all these satellites with SpaceX, and now China's complaining to the UN because he apparently isn't being careful about the flight path of the satellites. And of course he's not, because he's launching hundreds of them. So he's launching hundreds of satellites, and they almost hit the Chinese space station. And they're a constant danger because they didn't coordinate with everybody as to the path of their satellites. So you know, I mean, you know, he's not immune from prosecution. China goes to the UN prosecutes him. He's going to pay China whatever the hell fine they decide to have, and they're going to have to start adhering to international space standards, which they've been basically just completely ignoring so far. You know, I'm sure you guys know that there's like a ton of junk in space, and it's a big problem. Space is, you know, that's why when he announced that plan to launch all the satellites a long time ago, I was like, I don't see how you can do that. It's just, you know, there's only so much space in space, because a geosynchronous orbit is, I forget, like 100 miles above the Earth or something like that is geosynchronous orbit. There's only a certain band where all this stuff can be, and it's already full of stuff. So you know, it's great to talk about this and how great it would be, but if you don't cooperate with anybody, Earth orbit crowded. Trying to see what's real. Oh, yeah, look at this. Okay. I mean, I can't tell you exactly like what's real and what's not real, but generally, you know, they're talking about what's planned here. And without getting into reading all this is literally what's happening though. Okay, this is what it's like. And this is not good, obviously. And then, one thing gets hit and it bangs into, it breaks up and it turns into like little dangerous pieces that start hitting everything else, and you cause massive disasters. And that's what crap looks like around the earth right now. And they realize they have to do something about it, but the question is, what are you actually going to do about this? Here you go, some actual statistics. So, objects in space. Artificial objects in the Earth by year of launch and separation. This is by year. So they're saying in 2021, we put 25,000 things in space. That's pretty crazy, huh? That's in 1 year. So here's 25, 100,000 things in space, 200,000 things in space, 300,000 things in space. Yeah. So this is not an exaggeration. Not to mention the Earth astronomers are getting pissed off about this because this is kind of ridiculous. It's like hard to see the stars because there's so much shit in the way. So we will see, but it's not good. It's a big problem. And but that's why when Elon Musk says he's setting up a system that's going to put 1,000 satellites in space or whatever, it's like, what gives you the right? How do you get to do that? There's people need this space, and we don't have any particular way. What does this say? Oh, here. Low Earth orbit, 3,328 satellites. So that's where the real problem area is low Earth orbit satellites, 3,328. Oh, and here's a bigger picture of the same thing. Orbital, oh, here you go, Elon Musk. Okay, so we have 3,000 satellites in space now. Elon Musk wants to put 41,000 Starlink satellites in space. China wants to put 13,000. This is why, and by the way, this is why they complain, right? They're like, hey, we want to put our satellites there. Then OneWeb and Link and these other guys. I mean, this is kind of kooky, huh? Everybody wants to use this part of space. Number of debris objects by size, 34,000 debris objects by size that are greater than 10 centimeters. So there's also debris on top of that. There's 900,000 small pieces, 128 million things that are smaller than a centimeter that are debris in space also. So there's all the old shit that's broken up in pieces of stuff and things flying around. This is like a total disaster. We've polluted space basically. That's interesting. But and it sounds it seems a little irrelevant, but it's not irrelevant because when you hear somebody tell you invest in SpaceX because they're doing this thing and putting 41,000 satellites in space, you have to understand the feasibility of it. And immediately in their first round of satellites, where they only put up a couple of hundred or something like that so far, China's like, hey, screw you. You almost hit our space station. Now, possibly they're exaggerating it because, like I said, they want to put up their own bunch of satellites, and they don't necessarily want to cede all of space to Elon Musk first. But China is right going to the UN demanding that there are going to be some better rules in place for whether or not you're allowed to do these things. So that'll be interesting. So values. Oh yeah, and this morning, speaking of values, we were talking about the portfolios. We got the short-term portfolio, which I made some changes to in this morning's article. We can find that. Whoops. Yes, I want to log in. I'm not even going to talk about the COVID. This is bad. Look at this. This is bad. And they say, you know, they say, oh look, you know, deaths and hospitalizations aren't so bad yet, but you don't get hospitalized the day you get COVID. So, you know, here's the same Fed 2020 chart. These are all the same time frame, but it's kind of a little hard to see. I wish there was something in here. I wish it would tell you 2021 would be easier to tell. But realistically, your cases start spiking up. You see how fast the cases spike up and how long it takes for that to come back and hit the same thing. So, you know, when you're in a rapid, and this is so rapid, there's no way that you're going to see these hospitalizations and deaths come up at you until, you know, a week, 2 weeks, 3 weeks after. You'll start seeing these things move up. So to say that we aren't seeing the number of deaths and hospitalizations match the number of cases and therefore everything's okay, that's just stupid. We know better than that. Oh, but I wasn't going to talk about that. Okay, so let's not talk about it. This is also, look at this, freaking Washington, D.C. This is these are the cases per 100,000. They're up to like 300 cases per 100,000, which is what, 3 per 1,000, I guess. So yeah, so every day 3. Wait a minute, 300. So 100,000 divided by 300. 333. So 1 in 333 people every day are getting COVID in Washington. So that means, by the way, if it's 1 in 333 people every day, that means at the end of the year, it's everybody. Think about that. If every day 1 in 333 people gets COVID, in 365 days, everybody gets COVID. So this is not like, ooh, that sucks for them. This is like that sucks for everybody. They're on a path for 100% infection. 100% of the people in Washington will have had COVID by the end of the year at that pace. Of course, you hope that pace doesn't last, but this is just, you know, this is not something that's happened before. This is incredibly infectious. So that's why we're being careful. Here we go. So the short-term portfolio. So the short-term portfolio, like I said, is holding up okay. Even though the long-term portfolio is doing well, we're okay here. And so what we decided to do is we looked at the SQQs, and because they're cheap, the $5 calls are cheap, or well, they're not that cheap, really. I mean, you're paying $2 for them. But the $500 calls are reasonably priced. If we're paying $7, right? We're paying $5 plus $2. So if we're paying $7 and they're at practically $6, then we're only paying $1 in premium. It's only half premium. So when we pay $42,000, 50% of it is premium. That's not terrible for an ETF that can go up to 9 very easily. If the NASDAQ drops 20%, this will go up 60%, and that'll take it to 9. So we are in the money at 7, and then we make all of the money when we double it at 9. And that's a 20% drop. And don't forget, the thing about a hedge is you want to be hedged against a 20% drop. That's a sensible correction. But it's also nice to know that if there's a 30, 40% drop, which we had back March of 2020, we had a 35% drop. You want to have something in place then. In reality, though, the market does have brakes on it. Can't necessarily drop much more than 10% in a day. And so we have time to buy more hedges. So when there's a really serious drop for a really serious reason, and we think it's going to continue past 20%, we can take the money that we make at the beginning, use it to buy more hedges, and we're good we'll be good to 30, 40%. But initially, you want to be comfortable with a 20% drop, because a 20% drop like 9/11 can happen so fast that you have no time to do anything about it, and then you're just screwed. So if you just have a portfolio and it just drops 20% on you, It's too late to hedge. In fact, probably it's a terrible time to hedge. You can't save it. If you're not prepared for it, there's no fixing it afterwards. This is why we do these things. The hedging is to prepare you just in case, and hopefully it never happens. And like I said, if it never happens, the frickin' long-term portfolio made $100,000 in 2 weeks. That's what happens in a bullish market. Our long positions make a frickin' fortune. So we're not worried about losing $50,000, $60,000 in a short-term portfolio if the long-term portfolio is making $200,000 and $300,000. So these hedges are like gold, but what it does do is if the long-term portfolio drops $500,000 in a 20% dip in the market, the short-term portfolio makes $500,000 and we've still got all the money we started with. That's why it's worth it. You give up 10, 20% of your upside to have your downside protected. That's what this is all about. And again, think of the position you're in, because here's the thing. If the market drops from 100 to, by 20%, 0.8, so if the market drops from 100 to 80, and your portfolio is 2 million, and it only drops 10%, I'm sorry, and your portfolio is 100, let's say that, and it only drops 10% to 90, now you have $90 to buy stocks that are priced at 80. So you don't have to stop yourself from losing all the money, but as long as you mitigate the damages, you have more money per share of stock than you had before. You can take the money and start buying stocks that are now cheaper with the money that you would have wanted to buy the stocks with before. That's what's great about it. And the other point is, though, that you're able to liquidate, because the balance of cash in your short-term portfolio versus the positions in your long-term portfolio, if you see things that need to be liquidated, you can, because you don't have that fear of missing out. You can afford to buy the gems that go on sale and get rid of the stuff that looks kind of hopeless after the drop, because after you have more information, after you know what happened, after you know why the market crashed, you can then assess and say, here's what I buy. Like, for example, in March of 2020, we may have had, in fact, I think we did have like Royal Caribbean or something like that. We may have had Delta Airlines. I know we had Alaska Airlines. You know, there are some things that we liked in the travel industry. We may have had Expedia or something like that. When the crash happened, we don't just mindlessly put more money into cruise lines. We don't put money into airlines. We don't put money into travel agencies. We said, ooh, or IMAX is another one. We said, ooh, this is the problem. We have new information. There is a problem. The problem is there's a contagious disease. Therefore, all these travel stocks are a bad idea. Therefore, IMAX is not necessarily a good idea right now. So we cashed out, even though we took a loss, even though we love the companies long term. You take the loss and you put it into, but then we said, oh, Pfizer is on sale. Why is Pfizer sold off when they're the guys who are going to be curing this thing? Why don't we invest in vaccine stocks? Why don't we invest in pharmacy stocks? Why don't we invest in this and that? Why don't we invest in Walgreens, which never went so well, but I mean, conceptually, what do you invest in for pandemic? We went with 3M because 3M had the masks, right? That seemed pretty obvious. How are they doing now? We took the money and ran on 3M, but I don't know how they're doing. Nope, one more M. Nope, see, that's why we got out. But yeah, so 3M makes the mask. So people, because you know what it was, people aren't using the 3M mask. That's what it was. We went into it because 3M is the premier mask manufacturer. But as it turns out, everybody wears these ridiculous, 3-ply masks that basically do nothing. It's a joke. So, 3M makes masks, but nobody's buying those. Or, well, I mean, hospitals are, but other than that. So it turns out we should have bought cheaper mask companies that were making shitty masks, but I don't know, it just didn't seem right at the time. Anyway, point being that you look at what's on sale, you look at what is going to benefit, and you change your portfolio around. But you can't change, it's hard to change your portfolio around if you're getting hit and you've got this incredible loss and you don't want to get out of your lost positions because you hope they're going to bounce back and blah, blah, blah. It's not the right way to play. But it's hard to not play that way when you're in deep pain in your portfolio. The hedging allows you to do the right thing. It gives you the freedom to do the correct thing because you've got plenty of cash. On the whole, if you liquidate everything, you've got about as much money as you started with, and you can just start now picking out the stocks that are going to work in the future based on all the new information you have. So that's why we hedge. That is the point of this stuff. So here, what we did is we added 100 more calls. And also, this is a thinking ahead kind of thing. When we add 100 more SQQs, $5 calls at 211, right? Last time we sold these calls for 210. So we're buying them back right now for $1. Wait, what did I say to do? We're going to buy back the short. Oh, I'm sorry. No, we're buying back. We bought these. We sold these short March calls for 105. So, oh, I'm sorry. When we bought these, we sold these for 210. So we had a $2 net, right? Now we're buying these for 211. We can get half of this money back easily, or we can get all of it back if this has a little bit of a bounce. If this bounces back to 7, we're going to be easily able to sell something for $2, and we'll have a practically zero cost. We'll sell a higher strike for $2. So we're only lending the position $21,000. We're going to recover at least $10,000 of that selling short calls, and again, we now have more of an opening to sell the next short calls, the next short-term short calls. These March calls we sold for $10,500, and we are now buying them back for $1,800. So we have a $8,700 profit since October. So since we have 2023s, we basically have a year to make sales like that. So if you look at the position overall, we're in for 83,000 minus 21,000 minus 11 minus 17. So we're in for about $35,000 here. Okay, and we just added 20, so now we're in for $50,000 total, or let's say $55,000. So if we're in for $55,000 on this position, now we have 300 longs at 5. We don't stop until 12, and we're not going to sell calls that are not, if we're going to sell calls, we're going to sell calls that have a good spread. So we can get up to $7 back times 300 is $210,000 on a $55,000 hedge. But that $55,000, we're going to every quarter sell $10,500 worth of short calls. So we're going to collect $40,000 back. And the only way we get burned on the short calls is if the long spread goes into the money. So the net cost of this over time is going to be maybe $10,000 to have a couple of $100,000 worth of protection. So you can't think of a position as being the cost of now. You're intending to rent the position out. It's like buying a rental property, right? You don't buy a rental property and say, "Oh God, that was a waste of money. We didn't rent it out." No, you didn't rent it out yet. You have to look ahead to your cash flow. It's a business. And buying positions in stock. Well, that's basically what we're trying to teach you here, is that buying positions in options and buying a spread is a business. You don't play to win or lose the position you have. You play to create an income producing opportunity that will greatly enhance the probability that you're going to come out ahead. And that goes for your hedges too, especially goes for your hedges really, because they're technically lost money. We expect to lose. We hope we lose on the hedges. If we don't lose on the hedges, something went wrong with the entire economy. And as we've seen in the last couple of years, that's not really good. It's not a very pleasant thing. And you might make a lot of money, but then your phone is ringing off the hooks with people who need money. I'm sure you all have that, right? I mean, there's a lot of people who are hurting, family, friends, and things like that. And, you know, you might not get taxed and you might do well in the market, but, you know, there's a lot of people who just need help in the end. So whether it's a charity or whether it's friends and family and whatever, it's always nice to be in a strong economy, especially making money in a strong economy. So I said another short that's exhausted itself is 20 TQQ 130 puts. So in TQQ, we have 20 of the January 200 puts, the 2023 January 200 puts. We sold the 2023 150 puts. So we have a $50 spread here, and we sold the January 130 puts against it. Currently, TQQ is at 169. It's well above that. So these are expiring worthless, but I don't see the point in taking a chance. So we're buying these back because we're bearish, and it wouldn't take much for 169 to turn into 130. This is 170. So figure a 20% drop, a 25% drop on this, and all of a sudden you're at 130, and then this position's in trouble, and we don't want that. We want to cash it out. When we're up 90%, just cash it out. Why take a chance? We think the market could be weak. If we go down and we do end up hitting our 150 target, this will be a $100,000 payback. And what did we spend on the spread? We spent 130. Well, that's about 100, right? So there's 100. So we spend $30,000 net dollars, and we can get $100,000 back if it's below 150. Not to mention, though, that this is December. So we sold in 3 months. We made $20,000, $25,000 selling short puts. So since we only spent now net $30,000 on the spread, the next time we have a successful short put sale, this hedge is free. And you see what we're doing? We work our way into the hedges being free. We hedge, but then we hedge the hedges. But we do it incrementally so that if they trigger, we don't get, you know, we don't end up with nothing. And then with TZA, here's the position here. And I said, let's just buy back 50 because this is a really good position. This is net, see these numbers? Net $4,750. And it pays $400,000 at 40. So in other words, if this goes from 26.95 to 40, which is not a big move, which is if the Russell falls 20%, this goes to 43. So then these 20 calls will be $20 in the money times 200 is $400,000. So this thing pays off $400,000 against 47.50. But the thing I didn't like about it is that the January 23 calls, we have a lot of them. In fact, notice that we were oversold, right? We sold the 2024 40s, which is our cap for the position. We sold 100 of those. We sold 100 of the January 50s, which are way out of the money. But then we sold the extra, the short term, and it's the same one as these, but we sold an extra 100 of the January 50s. Now, we think it may expire worthless, and we'll collect the whole $77,000. And we're already up $25,000 on that one. But it's conceivable that it puts us in trouble if TZA does have a sharp drop in the near future. So just to be a little bit more bullish, we're going to buy back 50. So now we only have 50 short calls against our 200 long position. So that makes us a bit more bearish, and it makes us a bit more flexible in that if there is a big dip and we decide to take advantage and sell 50 of these because they're 208,000. Let's say they go to 400,000. We want to cash 50,000 out or 100,000 out. We might want to take the cash. So then it would be nice if we didn't have so much coverage. So taking it off now, even while these are up, is a good plan. So we're taking a little bit off the table, and it leaves us a little bit more bearish than we were. But again, it's a short-term investment because currently, where's the, oh, we didn't do that. If you look at TZA, all right, and again, it's not just the chart, it's what we feel. We feel that there's a big problem looming. We feel that these small businesses are going to get shut down. We feel there's going to be a big problem for retail and everybody else in the next few months because of the virus. not a complicated premise, right? So if TZA has a spike, look at how these spikes go. They're like $6 spike. There's a 20% spike, 20% spike. 28 to 32 is a little less than 20% spike. This is a God knows what spike. 22 is like a 50% spike, but easily could make a 20% spike. So we could easily see 30, 32, easily. So that's when we're going to want to sell. So opening up the spot now to sell, and then we could sell something even higher for a better price, that's the position we want to be in. So that's how we hedge the hedges. So overall now we have like 650, with these changes from today, we have like $650,000 worth of short hedges here. The whole portfolio, now, it's conceivable to lose more money than this portfolio is worth. In fact, right now it's negative 33,000. So we have 157,000 in cash, not counting today's changes. We have 157,000 in cash. The actual positions are worth negative 33. So we can lose more than $124,000. So we do have to watch that, but most of our losses are coming from Broadcom is killing us. Chipotle is killing us right now. So if there's, and we're not even talking, in fact, I wasn't even talking about those as far as being money that we could make, but you know, this is just basically, you know, Chipotle's $1,500. That's not going to happen most likely. Broadcom, these things went out of control. We just moved to these recently. We're down $15,000. So we could still lose money, and we could lose more than the portfolio's value, but I don't think so. So, you know, you just got to watch it. We have to make our adjustments on a regular basis. The short-term portfolio is our most adjusted portfolio. We have to adjust as conditions dictate. And again, point being that the long-term portfolio, though, makes $100,000 when this thing gets killed. The only reason this is getting killed is because the longs are doing great. And so our long-term portfolio just keeps kicking ass. In fact, if it's still the same, let's see where we're at. Yeah, 340. Holy crap, I think it's up today. That's sick. I don't know, I think that's down a little bit. Okay, so $2.2 million is 340%. That $2.2 million, that's as much as we had total long-term plus short-term last month. So now the long-term portfolio by itself is worth as much as the long-term plus the short-term portfolio was a few weeks ago. So it's gained the entire short-term portfolio in value basically during the last couple of weeks. So if that's a dynamic, if we lose the whole 100,000 in the short-term portfolio and the long-term portfolio goes up a couple of 100,000, who cares? Then we would take some of this cash, 1.7 million. We would take some of that cash and make a new and replenish the short-term portfolio. But that's never happened actually. In fact, we still have the same starting basis, right? In here, we have the same $500,000 starting base. We never put money into the long-term portfolio from the short-term portfolio. It would have added to the basis. So in 2 years, we haven't actually added money to this portfolio. We rode out the last cycle of the crash. We had money on the side and we did really well. In fact, well, obviously we did really well. So we've never had to touch the long-term portfolio as far as adding to it or anything. What else is there? Futures, how's futures now doing? 122 is pretty good. I don't remember where we were, and I'm not going to start looking at all these. Money Talk was up exactly 100 at some point, 130, 132. This is up 32. Oh yeah, we were just saying the other day it was up 126. So the Money Talk portfolio is what gains 3,000 today. You know, we don't touch this. This one we don't touch at all, right? We didn't touch it since we did the changes in December, December 1st. So for the month, we were at exactly 100 on December 1st. for the month, we're up $32,000. That's crazy. And we only have 73,000 worth of positions. So that's even crazier. And obviously if we're up, it's because of these positions, not the cash. So we had 40,000 worth of positions and we gained $32,000. I mean, that's nuts. But a lot of that is IBM. Look at freaking IBM. It's up about more than $10,000 on one position. Trade of the year. All right, how are things holding up? Oh, we're still right at 47.80, still the right line. Everything looks good, no problems. So anyway, so that's what I was talking about today. It's really important. I mean, it's honestly, this is the most important thing, is to get used to hedging. You got to learn to lose money intentionally. And you should be losing money on your hedges, but not too much. And you have to just learn to manage that and have it be a reasonable percentage of your gains that you lose. And like I said today, we made $100,000 in the long-term portfolio. So I don't care what I made or lost in the short-term portfolio. I care I made $100,000 in the long-term portfolio. Therefore, not that we needed to move the money because we have so much cash in the short-term portfolio. We have 157,000 in cash in the short-term portfolio. So we're not moving the money, but we made on paper in the long-term portfolio, and always keep that in mind, it's only on paper. That I say I want to take $30-something thousand, a third of that money, and spend it in the short-term portfolio to make more hedges. And generally, I'm going to be hedging 3 to 1. So I'm going to use $30,000. You know, want to hedge 3 to 1, 4 to 1. So if I'm going to spend $30,000, I'm going to give myself $100,000. I'm going to lock in those gains. That's the key. I'm going to lock those gains in so that I can't lose them, or shouldn't lose them. Not that you can't. I mean, things can go exactly wrong in 2 different places. Like the worst possible thing happens, and one thing does this, and one thing does that, and they both lose. It's unlikely, but it does happen. But so here we got 21,000. 20 is going to have, I mean, $23,000, $25,500, $50,000. All right. So we spent about about $52,000, let's say we spent. But like I said, we know we're going to get 10,000 back. Where was that? So we know we're going to get 10,000 back selling some SQQQs down the way. We know we're going to get 10,000 back on the TQQQs down the way, and that's just on the next sale into TQQQ. Oh, I'm sorry, that's because you can see it here. So the last time we sold the TQQQ short calls, or short puts, we sold $28,000 worth of them. We're buying them back for $2,000. We're going to sell another $20,000 worth of short calls for the next quarter. This is a 3-month trade. And we're buying, it was a 4-month trade, but we're buying it back in 3 months. We didn't need to wait 4 months. And why should we? Doesn't make any sense, right? We only have 9% left to gain, 8.5% left to gain. So point being, we sold 28,000. We don't want to sell it now because TQQ. That's a Y. TQQQ. We don't want to sell it now. Why don't I want to sell a put now? Because it's too high. When it's here, I want to sell a put. I don't want to sell a put here. This is where I buy back puts. This is where I sell puts. This is not hard. I see a channel. I'm going to play that channel until it breaks. Not complicated, right? So this is the point at the top of the channel that I want to buy back my short puts. When it comes back down here, I want to sell my short puts. That's where I feel comfortable doing it. What was I just doing? Oh, I'm sorry. So yeah, so we're going to collect 10,000 here, 20,000 here, and 10,000 here. So I spent 50,000 now, but I know that I'm going to get all that money back over the next 3 to 4 months. I know I'm going to pull it back in by selling short calls and short puts on those positions. In fact, my moves were set up not just to protect ourselves, but to set us up to do that in the next quarter or on the next dip. I set us up for future success. You got to plan that now. You have to position yourself now so that when we have a dip, then we sell the short calls, then we collect the money back that we laid out. And we've been doing this. This portfolio was started 2 years ago. Go back 2 years. Go back 10 years before that to all the short-term portfolios. This is how we do it. It's not the same as the butterfly portfolio, but it's not dissimilar either. We basically set up long positions that are bearish, and then we sell short-term positions to generate some cash while we wait for the bearish place to play off. If they never pay off, we just keep all the money from the short-term sales that we make. And if we're smart and if we keep it under control, then those short-term monies that we sell over the period of time that we're protecting ourselves pays for the entire position. And then we've got free hedges. And that's why when there's not a crisis, the value of the STP will tend to fluctuate between, it shouldn't go much below 90, 75, 90. But it did. It went down to 50. At some point, it went down to 50, and we added another 100 because usually we start the STP with 100. We did start the STP with 100, but we added 100. We pulled 100 from the long-term portfolio at one point when the market. It was after after the big crash. After the big crash. Then the market rocketed up in 2000. So early on in the cycle, we didn't have a lot of protection in place, and we wanted more money to hedge because the long-term portfolio did great, but then the short-term portfolio was completely inadequate covering it, and it was down to $50,000, and there was no way we could move the 50,000 around enough to cover the long-term portfolio, which was up like $500,000. So at the time, there was no possible way we could use the short-term portfolio as 50,000 to cover the 5, so we had to take one out of the long-term portfolio and move it to the short-term portfolio. That's why this says now $200,000 basis. So, point being, the short point being, what was I saying now? I lost track. Right, yes. So over the time, the point is that we take these, we make these short-term call sales, short-term put sales. We draw an income off that, and that feeds this. That's what I was saying. And that's, again, when we took the 100,000 out of the long-term portfolio, it's almost like a loan. We could pay it back now, but I don't want to leave us with $50,000, so we're not paying it back now. We are keeping the working capital. And also because the long-term portfolio got so bloated, it certainly doesn't need the money. It's got 1.7 million in cash now. It doesn't need the money. It never needed the money because the long-term portfolio was just sort of well-timed, because we only started it in, well, the same time we started this. We started the long-term portfolio in October of 2020. 2020. No, we didn't start the long-term portfolio in 2020. Pretty sure it's 2019. Yeah. Oh, I'm sorry. We started a long-term portfolio. We had started a new short-term portfolio at some point, but the long-term portfolio we started in 2020. I'm sorry, 2019. Ahead of the virus, we were cautious into January, so we didn't have a lot of positions. Then the virus thing hit, the market crashed in March, and we were still sitting on almost all cash in the long-term portfolio, and we went gung-ho, crazy buying stuff when the market crashed, and then it came back so quickly that the portfolio went flying higher, and that's what actually led to all our success. We just, at the exact time that the market crashed, we were in a buying position. Not only that, though, but the short-term portfolio is well covered and so on and so forth during the crash. And that comes from our strategy, which is also when we're building portfolios, you hedge first, then you buy. You know, so we're always going to be like buying some hedges, buying positions to cover the hedges, buying hedges, buying positions to cover the hedges. That's how we start building it. Because the worst thing you can do is buy positions, then the market crashes and you weren't hedged. Which goes back to what I was saying this morning, right? Be hedged. You don't know what's going to happen. This Omicron virus could have been, instead of being less deadly than Delta, it could have been more deadly than Delta. And had it been that change right there, had it been more deadly than Delta instead of less deadly and more infectious, this world right now would look like a disaster movie. If all these people, 500,000 people on Tuesday or Monday or whatever day that was, if 500,000 people in one day came up with something where 10% of those people ended up in the hospital, 50,000 people, using up half of the hospital beds in the United States. Now, it can't be half, whatever. I think maybe a million hospital beds. That doesn't sound right, does it? I don't know. Anyway, whatever the number is, a lot. If you can't have 50,000 people a day going into the hospital, put it that way. It's just not a thing. It's just not going to happen. So, you know, had this been just a little bit less lucky for us, and society would be like unraveling right now. And this isn't over, and the mutations aren't over, and this isn't the last we're seeing of it. This is just the most recent thing. And as I was writing about, I think on Monday, we spent $11 trillion. We borrowed $11 trillion during this crisis over the last 2 years. Between the Fed and the federal government. And where is your test kit? Where is your testing center? Where are the drugs? Where do I find the government approved list of things to do when you have COVID? Where is the package I get in CVS? And by the way, this is what they do in Africa. This is what they do in Haiti. It's what they do in any civilized country. There's a disease. Here's the treatment for that disease. Here's the home remedies you should do. Drink this tea, drink this honey, have these vitamins, take this, breathe this, try this, you know, this medication. There should be a list. There should be supplies, and it should be a top priority to make sure there's adequate supplies, well distributed. There should be testing for the people who want it. There should be vaccines for the people who want it. How do we fail that with $11 trillion spent? $11 trillion. There are 300 million of us. 11, there's going to be a lot of zeros. 11,000, 11 million, 11 billion, 11 trillion. $11 trillion divided by 330 million Americans. Yep. $33,000 a person. And none of that went to make sure we stay alive. What the frick is going on here? Why don't we have masks? Why don't we have gloves? Why don't we have disinfectant? You know, not that we go buy ourselves. The government spent this money. What the hell did they do with it? You know, and we know what they did with it. They gave it to rich people. They gave it to poor people too. But when you look at these wealth charts, where the hell were those? When do we talk about that? Remember having that conversation. Was it yesterday? Seems more like a Monday thing. This holidays really screwed me up. I can never remember when anything happened. No, there were some good charts. La da 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 da. Think it was Monday. Or maybe it was over the weekend. Nope, not those. Oh yeah, there you go. Great. Okay. Oh, and this also, by the way, speaking of reasons to be worried about the market, this is economic confidence. You know, these are not these are not people that you talk to. That's the problem. You know, and I know some of you guys have companies and you work with people, and I used to, and frankly, I used to, you know, when I sat at a desk in a company that had hundreds of employees, and I would talk to these employees on a regular basis, I was a bit more in touch with like what's actually going on in the economy. It was more obvious to me. Now I rely on, you know, people I talk to and so on and so forth, but it's not the same as when you kind of like, you know, I know the secretaries, I'm wrapped up in their lives, I know their kids, I know this and that, and I hear them talking about this and that problem. It's a little different. It's like you're better in touch when you're actually working with regular people. It doesn't count that you like talk to lots of waiters and things. It's not the same. But anyway, I mean, look, these are not the people that we spend a lot of time talking to. This is the bulk of the country, though. They're extremely concerned. They have a big problem. And it's a problem that exactly here, this is 2007. So here's where we are right here, okay? And in 2007, early 2008, we were denying the problem. That's what we do. We deny problems. And we ignore stuff like this. And the market collapsed. And we went, oh, wow, how did that happen? Because you can see it here. You can see it coming. But you just pretend, you just say, oh, that's not what I hear. It's not what I see. And of course, you don't see it because this is us. In that same time, in 2008, 2009, the top 1% had, what would you say that is? That's like 25% of the wealth. Now they've got 30% of the wealth. That's 20% more wealth for the top 1%. And the top 10% had that now the top 10% would include the 1%. The top 10% in 2007 had, oh, I can't even, hang on, let me take a straight line. You can't see it. I'm going to figure it out. 45% of the wealth. No, I'm sorry, not 45, 65, sorry. It's from the top, so it'd be 65, it leaves 35. And now it's more like, yep, 70. So 5% more for the entire top 10%. 5% more than 65%. So their wealth grew about 10%. The top 10%'s wealth grew about 10% in the last 10 years. That's easy enough to remember. Top 1%'s wealth grew 20% in the same amount of time. Now, where did that money come from? Did the economy grow? Did everybody benefit? No, that's not what happened at all, because these guys in 07 had 35% of the wealth. They go from the bottom. So they had 35% of the wealth. which matches obviously since they had 65. And now they've got, and this is the entire bottom 90%. So they went from 35 to 30. They lost 15%, 12%, whatever it is, of the wealth. They went down. They have less than they had then by a pretty large amount. Because in order to make this many people this much richer, you have to make this many people that much poorer. That's how it works. And the problem is, when you give all your money to these people, to the top 1%, and tell them to trickle down, it doesn't really work. Comes to these guys, you know, and you know that. Where do you get your money? You get your money from the people above you. You don't get your money from people below you. Not necessarily, not too many of us from those kind of businesses where we get huge amounts of money from people below us. You know, if you're a retail store owner or something like that, or you have a, you know, if you own Time Warner, you get a lot of money from poor people. But generally, you know, your customers are in your own group or in a higher group or in the upper part of this group, but not many people, not many of us are in businesses where we're getting money from the people at the bottom. And that's why we end up getting kind of out of touch. And that's why we're surprised when we see like an economic indicator chart that shows such a drastic drop. And we say, how is this possible? I talked to Fred, he's buying a new boat. You know, I'm at the Mercedes dealership. Guy says everything's great. He's doing good. I was just at the Mercedes. I was just at the Mercedes dealership, and I was surprised. The guy was not complaining at all. He's saying, "Hey, sales are pretty good." He goes, "Whatever we do have gets taken off a lot immediately." You know, but that's not that's not a good sample. That's not really teaching us anything. Same problem you have with a small sample of stocks, right? We're not sampling enough. So this is what $11 trillion bought us. This jump, that's what we got for $11 trillion. The jump in wealth of the top 1%, the jump in wealth of the top 10%, and the drop in wealth of the bottom 90%. This gain is this loss. Because they $11 trillion, 1.1 trillion was taxed to these guys. 9.9 trillion was taxed to these guys. Then the money was redistributed. Everybody was taxed $33,000 a person. Every man, woman, and child is $33,000 more in debt. Doesn't matter whether you're a rich child or a poor child, because that's not how it works. We have a national debt. Everybody has to pay it. Now, theoretically, there's a proportion system here, but there's not, because these guys pay Social Security up to $100,000. Now, it's a joke because none of these guys earn $100,000. But they have a cap of Social Security. I think it's 130 now. I don't even know what it is anymore. But your Social Security cap is like $100 and whatever $1,000. That for them, that means that they just pay Social Security all the time on everything. For these guys, that means they stop paying Social Security in the middle of the year. For these guys, it means they stop paying Social Security in January. So Social Security tax for these guys is a month that they have to pay it. And it's done. It's over. They capped. For these guys, it's half the year. And for these guys, there's no such thing. It's just a joke that they say there's a cap. They'll never make that much money. You know, things like, and obviously all the other stuff, Medicare, Medicaid, things that FICA, unemployment, it all comes out of everyone evenly, but these guys pay the much bigger portion of their income. So all these taxes, you know, and this is when they say the top 1%, they love to say the top 1% pay 90% of the tax. It's like, yeah, you make 90, now this is wealth, not income. Income wise, they make like 80% of the income goes to the top 1%. Because this guy's not making $100 billion like Elon Musk made this year. Oh, and Elon Musk is like, well, Elon Musk like, wow, I'm paying 10 billion in taxes. It's like, dude, you became the richest man on earth. You last year, the richest man on earth with Bezos. You are now the richest freaking man on earth. You made over $100 billion this year. And of course, some of it's still in stock, so, not going to be taxable. But he's only paying $10 billion in tax on his $100 billion on what he gained this year. He's paying $100 billion in tax because he cashed out a bunch of his stock and he took $20 billion or whatever it is to the side, $50 billion, whatever billions he took to the side. Now he's got to pay some taxes. But that's what happens when you make $100 billion. You pay some tax. It's and again, I don't begrudge him making the money. It's like fine, although I do begrudge it because I think he doesn't deserve it. But I don't begrudge him making the money. So whining about it that pisses me off. It's like, how dare you? You're not being unfairly attacked. You're like paying the capital gains tax on the stock you have. It's not like somebody's singling you out. What? You couldn't hide it. That's what you're upset about. And that's his choice too. Don't be such a public person, and you wouldn't have to worry about it. There's plenty of guys who made There's plenty of guys who made $100 billion and paid practically nothing. So anyway, moral of the story: be rich, because you're going to need it. So work very hard to be rich. Make sure we're hedged. Like I said, now we're at 47.85 again, so I'm back to where I started on my shorts. But I didn't buy the shorts to make a quick $1,000. These shorts are for a big drop. If there's a big drop and we pick up some cash, that'll be nice. If there's not a big drop, then my positions are fine, my longs are fine, and it makes sense. So it's just a little extra hedge to have in a period of uncertainty. I just think it's important to have some hedges, but the important hedges are the ones in your portfolio, not so much, playing the futures. That's just extra money in case. It's just nice to have a quick, $10,000, $20,000 if the market really does tank out. Remember the last time I quit, I had the hedge, I had the S&P hedges, had them constantly on, and the one weekend, it was right before Thanksgiving. That's right. The Wednesday of Thanksgiving, I cashed it out because I was worried that the market might go up over Thanksgiving. And we came back Monday and it was Friday. We came back Friday and it was in the toilet. And I don't want to think about it. I could have made so much money. I'm going to be less deterred this time. I'm going to stick with it, I think. Anyway. All right. So that's good for this week. Please think about if you're hedged enough in your portfolio. That is the whole point of today. Is we have the positions, we have the ideas in the long-term portfolio. If you want new long positions, we just went over the money talk portfolio yesterday in the post. We talked about the money talk portfolio. There's plenty of ways. There's plenty of good longs to take. That's not the issue, but don't go crazy. This is a very toppy market, and I can't be more obvious than this. This is a big problem. This is a very, very big problem. This is worse of a spike than we have had yet, and it's only just beginning. Maybe it'll magically go away. Maybe it'll burn out. Maybe it's like a really fast fire that rages through the forest and burns itself out real fast. Maybe. But this is the most people I've seen where I know people every day, COVID. My mother is just telling me this one in the building has COVID, this one got COVID, this one got COVID. They're all gossiping about who's got COVID. That didn't happen before. It's much worse, and we don't know when it's going to stop. I don't know how anybody can look at this and say it's going to stop any second. It's not. So we don't know we might come back next week after New Year's and it could be up here. How long can you ignore that? And when these guys start catching up, when this and this start following and going higher, it's going to be a serious issue. So just in case, please be hedged. All right, and have a happy New Year, and we'll come back and do this again next week and see how things are progressing. All right, take care, everybody.